Welcome to the Investor's Edge podcast, everybody. I'm your host, Fred Stupart. We're here to share a long-term approach to compounding investment dollars. Join us as we discuss previous transactions and situations. In the words of Felix Dennis, ownership isn't the important thing, it's the only thing. All right, welcome back. I'm your host, Fred Stupart. This is the Investor's Edge podcast. On today's episode, I want to talk about share price volatility, as distinct from the volatility in business economics, revenues, margins, inventories, that sort of thing. Let's see what Buffett has to say about that.
Yes, volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure risk. The nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. Take it with farmland here in 1980 or in the early 1980s. Farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. According to standard economic market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now, people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, translated volatility into all kinds of measures of risk.
Buffett making that very distinction between the daily share price movements of a business versus how that business is doing on a fundamental basis. And his basic point is that share prices can move completely independent of how the underlying business is doing. The question is why everyone cares so much about this. Many institutional investors use credit lines that vary as a percentage of asset values. So as the asset value drops, available credit drops until potentially there's a requirement of a margin call. So the question is, does the same logic apply to the individual investor who's perhaps not going to be retiring for 20 years, doesn't need the capital right away, doesn't have some sort of monthly payment obligation, unlike an insurance company or an institutional investor? And in fact, might all this volatility be an interesting fishing hole for the individual investor to focus upon if the institutions are busy selling the shares because of the volatility? Interestingly, a real world example how fears can drive stock price volatility has just arisen. It's October the 8th. Hurricane Milton has formed, and this weekend we kind of realized it could be a Cat 5. So on Monday, many property casualty insurance stock prices dropped, some by as much as 10-20%. Others, like Arch Capital, fell about 6.5%. Overall, the index lost in the order of $75 billion a market. Interestingly, if we look back at hurricanes Harvey, Katrina, and use the loss estimates from those hurricanes, the insurance sector paid out between 25 to 50% of property damage estimates that were floated at the time. So if we use that 50% number and apply it to the current estimate of property damages from Hurricane Milton, which is about $150 billion, 50% 150 is about $75 billion. Stock market capitalization of the P&C insurance companies on Monday fell by almost that exact amount. However, start digging into the individual stocks in the property casualty sector and the logic starts to break down. So for example, let's take a look at Kinsale Capital. Kinsale Capital is an excess and surplus insurer based in Richmond, Virginia, and it's got some exposure to Florida. Property casualty insurance companies typically disclose a probable maximum loss, or a PML estimates the largest loss the insurer could possibly face from a catastrophic event, perhaps in a specific geographic region or state, typically within a certain probability or return period, example, a 1 in 100-year event. And they disclose that they've got reinsurance coverage of up to $127.5 million per event and up to $255 million for the policy year after their own retention of $47.5 million. So despite such such disclosures, their stock a $760 million hit in market cap on Monday, October 7th, in response to the fears about Hurricane Milton. So that's a hit of almost 3 times their worst expected 100-year loss. So this is a stock price chart of Kinsale Capital. You can see the large drop in share price place on Monday. We've highlighted there with the Hurricane Milton arrow. Another interesting example is Arch Capital. They're a P&C and reinsurance holding company that's made some fairly precise disclosures about Florida hurricanes in their annual report. They disclosed that as of January the 1st, 2024, our modeled zone catastrophe exposure is a windstorm affecting the Florida Tri-County with a net probable maximum pre-tax loss of $1.6 billion. So their PML, their probable maximum loss for a Florida hurricane in the populous Tri-County area, that's the Miami-Dade, Broward, Palm Beach counties, is $1.6 billion. And what we know of Hurricane Milton's current path is that it's going to hit Tampa Bay, roll through Orlando, and then exit on the eastern side of Florida around Daytona Beach. Real estate valuations in the Florida Tri-County area are far higher than in the Tampa Bay, Orlando area. So based on this, the PML disclosure of $1.6 billion would be on the conservative end of things. Arch Capital's market cap fell by over 6.5%, or about $3 billion on Monday, October 7th, almost double this probable maximum loss disclosure in Arch's 10K. So does this price volatility make sense to us, or are we kind of wondering what is really going on here? And on the surface, it would appear to be quite logical. Estimates were for $150 billion of damages coming from Hurricane Milton. Based on previous hurricanes in Florida, 50% of damage estimates had resulted in payouts by insurance companies, so potentially up $75 billion of damages incurred by property casualty insurance companies. The property casualty insurance sector fell by about $75 billion of market cap on Monday. However, when you start bringing specific knowledge into company by company analysis, you realize that the odds may have shifted somewhat in your favor for a particular bet. And with dealing with the stock market, you always have to think about your returns in terms of distributions of outcomes. Are you going to be hitting a tail event that is highly unlikely, but potentially either very damaging or highly profitable, or are you more likely to fall into that midsection? So again, we get back to the whole question of how you find risk. Let's bring Howard Marks into the discussion. He's had an illustrious career in fixed income investing, especially in distressed debt. He has written extensively on risk, volatility, and investing generally.
Hi, I'm Howard Marks, and this is How to Think About It. I believe that risk is not volatility. The academics developing investment theory, largely at the University of Chicago in the early 60s, adopted volatility as their measure of risk. I believe they did so largely because volatility is readily quantifiable and nothing else is. I think volatility can be an indicator of the presence of risk, a symptom, if you will, but it's not risk itself. If risk is not volatility, then what is? In my opinion, and in the real world sense, risk is the probability of loss. I think this is what most people mean when they say risk, and I think that this is what people demand compensation for if they're going to bear it. Now, another important question is risk quantifiable in advance? Like most things occurring in the future, risk cannot be anything except a matter of... I was writing my first memo about risk in 2006. I wrote about my belief risk is not quantifiable in advance. My belief risk is unquantifiable even after the... And I think this is a fascinating time. You buy something for $1, and a year later you sell it for $2. Was it risk? And the interesting thing is that you can't tell from the outcome. A profitable investment may or may not have been risky.
So the permanent loss of capital, the classic fixed income definition of risk. And like many institutional investors, running a large business, collecting assets under management, overseeing groups of portfolio managers, trying to judge the merits of each, he's unfortunately ought to come up with some sort of set of metrics to compare everybody.
Risk, in my opinion, is the ultimate test of an investor's skill. Return alone doesn't tell you how good a job the manager did. Key question is, how much risk did the manager bear to get that return? Now let's look at this range of managers. What we posit is that the market is up 10% or down 10%. Now let's look at some individual managers. First one is up 10 when the market's up 10 and down 10 when the market's down 10. Accomplishes nothing. You might as well have invested in an index fund that emulates the performance of the market. No skill, no value add. But what about this one? I think this is the most interesting. Maybe it characterizes me, maybe it characterizes Oaktree to some extent. Up 10 when the market's up 10, down 5 when the market's down 10. So market type gains in the good times, I think that performing with the market when it does well is good enough. Nobody should have the market when it does well. But if you can do that and at the same time be ready to decline less when the market has its down spells, I think that's accomplishing something very important.
So when it comes to trying to compare his various managers with each other. He needs a metric for that comparison. And rather than like a Buffett and resort to perhaps the performance of the underlying businesses by, say, looking at the growth in the book value of the businesses over a period of time, or looking to the growth of the earnings, instead, he's resorting again back to the price performance of the marketable securities, and indeed starts looking at the price volatility of those securities. And his preference is for a manager who perhaps is able to perform with the upside of the overall market, but then is able to protect the portfolio to some degree from downside or a bear market. And that's his sort of preferred manager. Again, someone who's slightly outperforming the market with less volatility. I think a lot of the difficulties surrounding the measurement of risk arise because it can be dormant in a portfolio for a long period of time and then pop up during times of distress. And people want to be able to make decisions on a much more compressed timeline. And so what does it mean to measure volatility? So this is your typical measure of volatility, which is the standard deviation of portfolio returns. The returns are typically reported on a monthly basis. And given that for statistical significance, you typically want at least 30 observations, that's going to be roughly 3 years worth of returns. So you take your 36 observations, take the average, and then for each observation, take the difference between what that return was for the particular month and subtract out the average, square it, sum it up, divide by the number of observations minus 1, because this is a sample, and then take the square root to normalize it, which is just a long way of saying that for two given portfolios, each of which are returning 2% annually, the one on the left is more volatile than the one on the right. The one on the left, because it's more volatile, is considered to be more risky than the one on the right. Institutional investors have derived a variety of different metrics in order to apply this concept to a portfolio. Perhaps the most commonly used one is the Sharpe ratio, which is the mean portfolio return plus the risk-free rate divided by the standard deviation of the portfolio return. Another commonly used one is information ratio, which basically is the mean excess return divided by the tracking error. The tracking error takes the standard deviation of the excess returns, and because it's taking a standard deviation of a difference of two numbers, the portfolio return and the benchmark, it'll actually be reduced to the extent there's a positive covariance, positive correlation between the underlying portfolio and the reference benchmark. Information ratio will improve to the extent portfolio manager has some exposure to the benchmark and so has that positive covariance with the benchmark. So it kind of encourages them to get a couple of the better performing assets from the benchmark into their own portfolio. So where does this leave us? If we go back to 2008 and compare the returns of ExxonMobil to Berkshire Hathaway, the S&P 500, Apple, and Google, that red arrow shows you returns of ExxonMobil, which is negative 28%, far outpassing Google's negative 49.75%, or indeed the S&P 500's negative 45%. If you were to try to make a pick based on the Sharpe ratio, you would say to yourself, ExxonMobil looks like a great stock to pick. However, then look forward over the next decade, see a 45% return for ExxonMobil and a near 1,500% return for Apple. And so is an historic look at the standard deviation of returns or securities prices a useful metric to be using as a basis for making go-forward decisions. Focus on creating a portfolio of well-defended, high return on equity, growing businesses that are responsible to shareholders, not increasing the share, hence growing their earnings per share over extended periods of time. That's all for this week. Talk to you soon.
Fred Stupart is managing member at Eaglestone Capital. The opinions expressed in this podcast do not necessarily reflect the opinions of other Eaglestone Capital partners. No information in this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of Eaglestone Capital Partners.